Diversification is one of the most fundamental principles of investing, yet many investors overlook its importance. In simple terms, diversification means spreading investments across different asset classes, industries, and geographic regions to minimize risk and maximize returns. A well-diversified portfolio helps protect wealth against market fluctuations and provides more stable long-term growth. The primary goal of diversification is risk management. No investment is entirely risk-free, but distributing assets across multiple investments reduces the likelihood of a single event negatively impacting an entire portfolio. For instance, if all money is invested in a single stock and that company experiences financial trouble, the portfolio could suffer major losses. However, with a mix of stocks, bonds, real estate, and other assets, a downturn in one sector may be offset by gains in another. One of the most effective ways to diversify is through asset allocation. Different asset classes, such as stocks, bonds, and real estate, have different levels of risk and return potential. Stocks typically offer higher returns but come with greater volatility, while bonds provide stability and income but tend to have lower growth potential. Balancing these assets allows investors to create a portfolio that aligns with their risk tolerance and financial goals. Industry diversification is another crucial aspect. Investing in a variety of sectors, such as technology, healthcare, consumer goods, and finance, reduces exposure to industry-specific risks. For example, during the 2008 financial crisis, the banking sector collapsed, while tech and healthcare stocks performed relatively better. A diversified portfolio would have helped cushion losses during such market downturns. Geographic diversification is equally important. Investing in international markets provides exposure to economies that may be growing faster than a home country. While the U.S. stock market has historically performed well, emerging markets like China, India, and Brazil have offered high growth opportunities at different points in time. Global diversification helps investors tap into different economic cycles and reduces dependence on a single country's performance. A well-balanced portfolio should also include alternative investments, such as real estate, commodities, and even cryptocurrencies. Real estate investments provide steady rental income and act as a hedge against inflation. Commodities like gold and oil tend to perform well during economic uncertainty, offering protection against stock market declines. Meanwhile, cryptocurrencies, though highly volatile, have gained traction as a new asset class with significant growth potential. Rebalancing is a critical part of maintaining diversification. Over time, some investments may outperform others, causing a portfolio to become unbalanced. Regularly reviewing and adjusting holdings ensures that asset allocation remains in line with the original strategy. For instance, if stock holdings grow significantly while bond allocation shrinks, selling some stocks and reinvesting in bonds may be necessary to maintain balance. Another effective diversification strategy is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, investors buy more shares when prices are low and fewer shares when prices are high, reducing the impact of market volatility and lowering the overall cost per share over time. Diversification is not just about spreading investments, but also about understanding risk tolerance and financial objectives. Younger investors with a longer time horizon may take on more risk by allocating a higher percentage to stocks, while retirees may prioritize stability by focusing on bonds and income-generating assets. Personalizing a diversification strategy ensures alignment with financial goals and stage of life. While diversification offers significant benefits, over-diversification should be avoided. Holding too many investments can dilute potential returns and make portfolio management more complex. The key is to strike a balance, enough diversification to mitigate risk, but not so much that it becomes unmanageable. The benefits of a well-diversified portfolio become evident during market downturns. Investors who concentrate their money into a single stock, sector, or asset class often experience severe losses when the market takes a hit. However, those with a diversified portfolio tend to see more stability and faster recovery. Over time, this approach leads to more consistent returns and helps investors stay committed to their long-term financial plans. Understanding and implementing diversification requires ongoing effort and monitoring, but the rewards are well worth it. By carefully selecting a mix of assets across various categories, industries, and regions, investors can create a balanced portfolio that stands the test of time. Whether a beginner or a seasoned investor, diversification remains one of the most powerful tools for achieving financial success while managing risk.